Hello, amazing people. Welcome back to the Multifamillionnaire podcast. My name is Cheddy Matthews, and I also have with me the phenomenal, amazing multifamily real estate mind, Selcuk and
Selcuk and
How are you? I love
Thank
how
you.
you say it.
Yeah,
You
yeah,
have to
yeah,
teach me how to
yeah.
say it that way.
I can say my name very well, right?
You say it better
I'm
than
good.
I do.
Yeah. No, you're good. You're good. And yeah, I'm excited to do this part two here. And we have another 14, 15, the terminology for the real estate. And
Yes.
I'm excited to do that today.
This is awesome. So we're going to dive right in because if you remember last week, we talked about the essential terms and phrases in multifamily real estate, part one. So right now we're going
Mhm.
to come back around full circle, bring it back to home base and give you part two. So this time
Yeah.
it's not going to be 21. We have 14 more terms for you to know. So break out your pen
Mhm.
and paper and get ready to learn a few things. So let's go. Let's go get
Yeah.
into it. We're going
Yeah.
to start with
Let's
number
get it going.
22, which would be
Mhm.
the first one for this week. Number 22 is gross potential rents.
Okay. Yeah, gross potential rent, also known as like a GPR, right? You see that GPR and all the underwritings and the reports. So a GPR is the absolute ceiling for rental income. Imagine your building is 100% occupied and every tenant is paying full market rent, not the current rent, market rent with no discounts, no moving specials. That number's your GPR. So why it's important? Because it gives you a benchmark. If you're underwriting a 20 unit property where GPR is 288,000 a year, let's say, and the seller tells you they're only collecting 240,000, now you know there's a gap. And either due to vacancies or poor management or below market rents. And that's where value added investors see opportunity. And that's why gross potential rent is important.
Love that. That is awesome. That was actually a great, that is like one of those things where if you're not thinking about that, that's where your potential comes from. That's how you can know what
Yep.
the, if you want to think of it this way,
Hmm.
the earning potential of the property is in the GPR.
Hmm. Yeah.
So now
Yeah.
here's
Yeah.
another one for you, which is very similar. It
Yeah.
sounds like it's one of the cousins. How about
Hmm.
such, if we can talk about gross scheduled income, GSI?
Yeah. Gross scheduled income, GSI. That's the what it's actually what the leases actually say today. So it is scheduled rent, not theoretical, right? So if half of your tenants are locked in at $1,100 per month rent, when the market 1,200, right? That's your GSI. Basically, so it's kind of a real world version of a gross potential rent.
Mhm.
And the difference between gross potential rent and the gross schedule income is called loss to lease. So the smart investors always look at that because it tells you how much rent growth is already on the table, just bringing the lease up the market. So yeah, I
Nice.
mean, just basically the GSI is what you're leaving on the table.
Mhm. Love it. Love it. Okay. And these all seem very close and the words sound very similar. But another one, the next term, number 24, is going to be gross rental income. What is that?
Yeah, gross rental income, also GRI, right?
Yep.
So that is about the collections. Now we're coming to do the step two. It is the rent you actually collected, you build or collected. Sometimes owners say, okay, we're 100% occupied, but if two or three tenants aren't paying, that's your gross rental income. That's your GRI. Basically, so whatever you're collected, uh, it is the total of to the balance. That's your gross rental income. And why is it important, especially in underwriting? Because the lenders don't finance fairy tales, right? they will ask for rent rolls and the bank statements. If your GSI says 266,000, let's say, but your GRI 256,000, the bank knows you're bleeding $10,000 in bad debt, basically. And also, speaking of bad debt, you can see on the trailing 12 statements, it's called bad debt as well. So, and then bad debt that hits your valuation basically. And overall, that's what the gross rental income means.
Okay. Wonderful. Next one is going to be the effective gross income, the EGI.
Mm-hmm. Well, EGI, this is the bottom line, right? So
Yeah.
EGI, effective gross income, is the most realistic income number. So you start with gross rental income, subtract vacancies and collection loss, and then add back other income like laundry, parking, storage. So, and that makes your, effective gross income. And let's say, give me an example. So you've got 256,000 gross rental, the rental income, right? You lose $12,000 to vacancy, just mentioned a minute ago.
Yes.
But you make 6,000 from laundry machines, right? So then you have to add that $6,000 to that balance. Your EGI is now 250 and change $1,000. That's the number lenders and investors really care about because it reflects what's really like to actually hit the bank. So the EGI, effective gross income, is the bottom line number. That is the net income, gross income after vacancies and after all the additional income, put it back to the balance. And what you see after that gross income, you're going to start to see expense line items, basically.
Ah, got it. That makes sense. Thank you for that one. Now, here's one
Mhm.
that you hear a lot. So hopefully you can do a deep dive into this one. This is number 26. This is the cap rate, capitalization rate.
Yeah, the capitalization rate it's like the heartbeat of commercial real estate. It is net operating income divided by purchase price. So it tells you the unlevered return if you bought all cash. So why investors should care about it? Just because cap rates let you compare deals across the market. A 6% cap in Houston, let's say Houston, Texas, might look good, but if similar assets are trading at 7% in Dallas, you're probably overpaying. So when underwriting, always you have to put the cap rates in the equation, and then it gives you. We're going to talk about it more later, but it obviously is the backbone of the future evaluation of the property.
Do you have a window? Is there a threshold as far as what a good cap rate is versus a bad cap rate? I mean, do you have any kind of a benchmark where people can look at it from a distance and say, that cap rate's kind of high or kind of low, or does it vary market to market?
Yeah, it's very market to market, right?
Okay.
So you can compare it. It's just like whatever the cap rate is for that market, that's what the sellers pick up. That's the numbers, the factor numbers the sellers pick up, right? And then that makes their selling price. And within the same market, similar market, especially, let's say we're talking about the same zip code or same neighborhood, if the cap rates on the same, the vintage year, well, same type of the properties, if the cap rate is kind of varies, that's where you want to really put your attention. Why, this seller put like a higher cap rate than this seller, the similar properties in the lower cap rate. So that makes like a cross check, double check opportunity
Got it.
for the buyers. That is
Okay.
important. Yeah.
Got it. Thank you. Thank you for clarifying.
Mhm.
And next one's going to be GRN. So your gross rent multiplier. That's coming in at number 27.
Yeah, the
Gross rent multiplier. Yeah.
gross rent multiplier, or GRM, and is like a quick screening tool. It's price divided by gross rental income.
Mhm.
Price divided by gross rental income. The lower the GRM, the faster you're theoretically paying off the property with rents. But unlike cap rates, it ignores expenses. So it's just the first glance, not the full story, basically.
Got it. Got it. And here's one that you hear a lot. You hear people say COC or cash on cash return. So at
Mhm.
number 28, what does that mean when someone says cash on cash return, COC? What are we talking about?
Yeah, the cash on cash is the return on actual dollars you put in, right?
Mhm.
If you invest, say, $100,000, and after the debt service, you're pocketing 10,000 a year. So
Mhm.
that's a 10% cash on cash.
Yep.
Basically, it's like a real feel of your money working for you, right? So it matters to passive investors because it tells them what they will see in their bank account every year. So basically, it's a cash on cash. Again, another very important factor number on the underwriting.
Absolutely. Agreed. That was actually a great explanation. I think people need to really understand that if you're investing, you want to know how that return is going to benefit you so you can plan for it as part
Yeah,
of your
yeah.
portfolio. So,
Mhm.
number 29, debt yield. What you got?
Yeah, and that yield sounds like a bank term, right? It is. It is a bank term. So the debt yield is net operating income, NOI, divided by the loan amount. So if a property makes 1 million NOI, net operating income, and the loan is 10 million, the debt yield is 10%. So basically, the lenders love this because it ignores interest rates and amortization. It is just, if we foreclose, how quickly do we get our money back? Type of
Good.
calculation. Yeah,
Cut and dry, down and dirty. I like that.
yeah.
So you hear this a lot. I hear people talk about this all the time. Exit, talking about how many years to exit. What is your exit plan? What is your exit strategy? What does it mean when they say the exit? The exit. What are we talking
The
about?
exit, that is your strategy to get investors' money back plus the profits, right? That's a plan. And that could be selling in 5 years,
Mhm.
refinancing,
Right.
or a partner buyout or whatever. And in underwriting, you model your IRR and equity multiple based on that exit, right? So if you don't have an exit plan, so you don't have an investment, you just own a building. That's it. So that's the plan you have to give investors upfront. Okay, even before they purchase the property, hey, this is the plan it will be, and we're going to hold the property, let's say 5 years. And you can say on underwriting, you can say, and you can show them the projected operating NOI within 5 years, basically the fifth year, let's say, as soon as we hit this NOI, and then this exit plan strategy is going to come into place. And basically, step by laying out everything. And then in the final, we basically going to tell them when the sale is going to be triggered, right?
Yep.
You
Perfect.
know, keep that in mind. They're all projections, but we want to make like a realistic projection. Basically, that's what the exit is.
Good. Thank you. That was a good one. And that was number 30. So now we're moving on to number 31. We are actually steaming through these, but these are really good examples. But at number 31, we've got the replacement cost. What is
Mhm.
that?
Replacement cost is what it would take to rebuild the property today, right? It's important because if you're buying at or above replacement cost, you have to ask yourself, why wouldn't someone just build new instead of buying your deal? So it also matters for insurance, obviously. So you want enough coverage to replace, what you own.
What would be some reasons why that would happen? I mean, I think about, living in California, I'm sure there's environmental reasons and rules and things like that. Or maybe it's a historic building and there's maybe some restrictions. But what are some reasons why you may that make that could actually make you pay more than you would expect to pay? What could happen? What could cause that?
Well, it's actually that's the market, right? And sometimes the cap rates go so low, and then all the numbers kind of get crazy, just like happened like a few years ago, right? And then when the rates, interest rates, like around 3% on the commercial for buys purchases, so that's a market. Sometimes it can go even beyond the replacement cost, but
Mhm.
to know the replacement cost to make you see and to realize where are you on that, where are you at on that, right? How much, if you're willing to pay more, or your investment, but at least you'll know how much you pay more.
Right.
And then you're going to factor that into the underwriting again, and that it's gonna help your projections realistically. It's always, you have to know the replacement cost and your purchase cost and replacement cost again, not necessarily to always the up and down or equal, but at least to know the replacement cost today. It's going to help you on underwriting. Period.
Yeah. Awesome. Now, here's one that you see a lot in commercial real estate as well. Price per square foot, number 32. What does that mean?
Yeah,
Why is that important? Yeah.
the price per square foot is basically simply the purchase price divided by total square footage. So it helps you benchmark across markets and asset classes.
Yeah.
So I mean, for example, $250, $250 square feet in Miami might be cheap, but in Dallas it's a price. It just depends on the market. So
Got it.
you have to take that price per square foot number, and then again, you're gonna. It's just like your starting point. And after all the capex, the budget you put on, then at the end of the purchase and the price per square foot, it will be changed, just because, if you have a value property you're into, and you have to put some capex on it. But at least after the purchase, where are you on the price per square foot, right? And then the projected sales for 5 years, and then you'll know on your underwriting how much you will sell, or you try to sell each, the price per square foot, the cost. So again, it's just another factor number, and it just tells you where are you and where you will be, or where you're willing to be in the
Right.
near future. That's why
Right.
it's important.
Wonderful. So that was price per square foot. And now at 33, we have average year built.
Yeah, basically that's the year your property is built. And when somebody's talking about the average year built, that's the portfolio, right? If you have a multiple properties, and instead of going one by one, it's just like a taking average, the year they built, and then you disclose in your underwriting and presentation and everything. And it is critical. And so let's say if you're, let's say your multifamily portfolio average years built in 1970, that's you're probably starting at plumbing issues and old roofs, and then that cause like a higher capex, right? And the lender and buyers look at it as a proxy for risk, and it gives you some kind of idea to what kind of the things that you have to deal with. Again, electrical, special electrical, the old wiring and all that stuff. Those are the things. It will cost a lot, and then you have to work on your capex. That's why it's important.
Awesome. That was actually good. Thank you. All right, we've got two more. We're coming to an end, but we've got two more. Another one dealing with space. It's going to be total square footage, number 34.
Yeah. The total square footage is like it's obvious one, right? So what is total square footage inside of the building? What is the total square footage? Well, what important is that is this. And whether it's apartments or offices or retail, your revenue potential is tied to a rentable square footage, not the
Mm,
total square footage, right? So you have to take the rentable square footage in your underwriting. And it also sets the like a baseline for price per foot comparisons, obviously. So
yep.
and just keep that in mind. It's rentable square footage, not the total square footage. That's
Mm,
the key word for square footage.
that is good stuff. And then we're coming
Yeah.
to land the airplane with number 35, and it is the parking ratio.
Yeah, the parking ratio is spaces, you know, per 1,000 square feet or per unit. Right? Parking ratio is a spaces per 1,000 square feet or per unit. So
Mhm.
it's a bigger deal than the people think, and it's especially in suburban office parks. It's if it's like a too little parking, it kills leasing. And multifamily, if tenants cannot park and they'll choose the building down the street, and in underwriting, your parking ratios can lower both rent and potential and exit value. So it just kind of give you an idea on the different markets and what could it be you know the rent ratios, the parking ratios. I'm sorry. So in suburban areas, usually it goes like uh, 1.5 to 2 spaces per unit.
Yeah.
And in urban, like a downtown areas, often like 3.25 to 1 spaces per unit. And the luxury communities can go up to 2 plus spaces per unit. And affordable or student housing sometimes like a half to 1 point per unit. So basically, you have to, when underwriting, compare the properties ratio against local zoning requirements and the market expectations. So a mismatch can lower demand or even trigger the city compliance issues and all that.
Wow. That was good
Yeah,
stuff. That was good. And one
yeah,
thing I appreciate you, Selchuk, for going for all these. That was 14 gems as far as terms go. And when you add those to the other terms, you have 35 terms that we've gone over in the two sessions, in two
yeah.
episodes of this podcast. They're all different numbers. They all give you
Mhm.
different things you can measure, different metrics, different considerations.
Yeah.
But if you're doing your due diligence,
Hmm.
Celtic just gave you the tools that will enable you to make sound decisions and increase investor confidence, also increase
Hmm.
understanding. People will not buy what
Yeah.
they don't understand. And you can now understand your risks, your opportunities, your threats, your
Hmm.
challenges. You can understand more of the picture when you use these numbers and know what they're used for. When I look at these numbers, I think of like an airplane and I think of like a fighter jet
Yeah.
or an airline that has all these dials and gauges and lights, and all of these numbers tell you something, whether it's a warning, everything's good,
Yeah.
watch out for this is too low. All the things on the airplane, all the dials and the gauges and the alarms tell you something and warn you of this or that.
Hmm.
Not necessarily good or bad, but now you know what the situation is, so you can make a decision
Hmm.
based on your investment strategy, what your
Yeah.
thresholds are. You can make those sound decisions, but it all starts from having the numbers, the terms, and the concepts, so you can do what Selchuk does better than anyone I know: due diligence.
Yeah. Yeah.
That's something I've
But
got to
this is
say.
the bottom. Yeah. This is the bottom line, right? So
Yeah.
when you do diligence and underwriting any real estate deal, you
Yes.
have to touch every single list items we mentioned last two the episodes. You have to touch every single of them. You have to make sure you put every single of them in your underwriting, and that every single of them is related to each other. And at the end of the day, it's going to tell you a story. And then it's just up to you how you can take advantage of that story, either in a good way or a bad way. So
It's
that's the
true.
bottom line.
Oh yeah. So this is really
Yeah.
good. I really thank you for
Yeah.
taking the time to do this. And you know, it's funny. I always tell you, I always stress the fact that you're so good and you have this high level of excellence when it comes to underwriting. But the reason I stress it is because if somebody had their doubts or they have some kind of, you know, uncertainties, you erase that because you give people all the numbers and the metrics so they can make their own decisions. And what you realize
Yeah.
with people is some people value one number over another. Some people, what is the cap rate? What is the cash on cash? People have some
Hmm.
people have like their warm and fuzzy number, and whatever that number is,
Yeah.
you have the ability
Hmm.
to show them the numbers that they're concerned with for their
Hmm.
own reasons. And because you're so thorough, whether someone's analytical, whether someone's emotional, no matter how people invest, you probably have a number that will satisfy their needs. Whether it's the bank, the investors, anybody else that's involved in that transaction, you have numbers that will let them make sure the deal works for them. And I think that's
Yeah.
amazing. So instead of trying to make a square peg fit in a round hole, you find the right peg for the right hole. And I think that's amazing. I think that's amazing. So
Yeah. That's
really,
well put. Well put.
no, it's golden. It really is because you know a lot of people aren't sharing this information to help people get started, and people are lost. Like
Hmm.
I've got this sheet. I don't know what to do. I see all these numbers. I'm confused. What am I looking at? What should I do now? And here you are. You just gave them 35 terms with formulas where they can go in and figure out, punch in the calculator and see what number pops out. But oh, that's that
Hmm.
number. Oh, that's that number. Okay, let me look at this and see if these numbers are good, bad, indifferent, whether it's good for me or good for someone else. You never know, but you're giving people the ability to make sound financial decisions when it comes to multifamily real estate and other asset classes. So I wanted to thank you for that.
Yeah.
Anything
Well,
else to add?
thank
I'm gonna give you
you.
the final word before I close out.
Well, here's the final word, right? It's a simple. When you do your underwriting and due diligence, I'm repeating myself, but it's so important.
Yes.
Don't try to convince yourself. Don't try to convince your desire to purchase this property. That's a whole different thing. Don't try to convince yourself. Just use these metrics, use these formulas. And at the end of the day, just look at the last number, if it makes sense or not. If it doesn't, you have to close the book and just move on to the next one. That's the bottom line.
That will probably save people from burning through their money, hurting their
Oh
pockets,
yeah.
and having less sleepless nights. So once
Oh yeah.
again, always with the gems, Selchuk, I thank you for this. And I wanted to let the multifamilianaire community know if you like this podcast, please like, subscribe, share. Somebody may need this information. So send it on to them. Give them the link. Let them know where to find us. We are out there on everywhere where you listen to your podcast and your social media. Please follow us and look out for the next episode of Multifamillionaire Podcast. Everybody, thank you and stay amazing.
Yeah. Thank you, everyone. Thank you.